if the trend continues this way, if your concerns continue to mount, could there be a point where, in addition to just betting on increased volatility, you're starting to do things like either reducing your market exposure, like I'm just moving to cash because I'm worried about the market, or maybe even flipping on the short side and saying, I think the probability of this is now big enough that I'm willing to take short positions against it.
Well, I'm already there. Like
You're already,
I'm already betting against a lot of stuff. So I
okay.
will have some longs, but I think right now, if I had to look, I am net short.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. On the famous Fear Greed Index, after spending most of the past year and a half in greed, we've suddenly switched to fear over a very short time frame. The S&P is broken below both its 20 and 50 daily moving averages. Inflation printed hotter than expected, making Wall Street start to doubt the Federal Reserve's ability to deliver expected rate cuts. And geopolitical tensions have puckered tighter following the escalation of hostilities between Iran and Israel. So, is the exuberant sentiment that drove the past year's bull market now gone? Or is it just taking a breather before continuing to climb what has suddenly become a much steeper wall of worry? For answers, we're fortunate to speak today with market veteran Kevin Muir, founder and editor of The Macro Tourist, the highly acclaimed newsletter that currently ranks as the 12th largest financial Substack in the world. Kevin, thanks so much for joining us today.
Thanks for having me on, Adam. I'm looking forward to this.
Good. Oh, me too. It's a pleasure to have you back on the channel. Well, lots to talk about. If we can, let's just kick it off with the general starting question I like to toss out. What's your current assessment of the global economy and financial markets?
Well, I do think you have to separate the economy from markets because I think that the global economy is actually doing quite well. And in fact, might even be surprising to the upside. But just because the economy is doing better doesn't necessarily mean that the markets are going to do better. One of the things that I worry about is that the stock market is priced in a lot of perfection, especially when it comes to the US. We're overextended, everybody is long. It really feels like it's time for a correction. And I actually think that it started off last Wednesday. It kicked off with a higher than expected CPI reading. We had one of the largest moves in the 5-year part of the tenor of the yield curve that we've had. I think it was the largest move since March of 2020 in terms of basis points of yield increase. I think that kind of kicked off what we're experiencing, which is I call a VAR shock, meaning that we have increased volatility. And when you get that sort of increased volatility, what happens is market participants have to reduce their positions. And that is, in essence, what has occurred since then.
Okay, so basically things are getting more volatile. People have to prioritize risk management a little bit more. And so this is almost the equivalent of the guys are on the poker table. It's been hot, but now they're maybe taking some of their chips off the table.
Yeah, and I actually think it's even more symptomatic than that in terms of if you look at things like vol control strategies, which have become much more popular. And what they do is they, in essence, lever up and down depending on the realized volatility of the S&P. Those sorts of strategies have increased. And also, let's face it, the pod shops, the Millenniums, the Exodus, all of those folks, those hedge funds are becoming a dominant force in the markets. And as they become more dominant, their strategies are affecting the markets in an increasing way. And one of the things about their strategies is it's very sensitive to rates. To volatility. So when volatility dampens down, they increase the leverage. And when volatility goes up, they decrease the leverage. Same with the sell side that's providing making markets in these things. The same, it's across the curve. When volatility increases, position sizes get smaller. So therefore, you often see that as this cycle of increased volatility causes more selling, which then causes increased volatility, which then
Right.
causes smaller positions.
So how do these cycles tend to work? Do they tend to be short and swift? Do they tend to be about as long as the periods of stability that preceded them? Because we've had volatility, at least as measured by the VIX, has
Right.
been suppressed or at least really quiet for a long time.
So it depends on what kind of time frame we're talking about. And I'm not sitting here telling you that we're about to go to the you know, GFC, VIX to 80, and we're going to have some
Yep.
sort of event like that. All I'm saying is that we've had a period where the market has been doing very well. Volatility has been coming in. And now, for the first time, we're starting to have some hiccups. People are a little extended over their skis. And as we see more and more of these little volatility clusters kind of pick up and percolate through the system, it creates kind of a feedback loop. And where that feedback loop stops and ends, it's difficult to say. I'm not as interested in saying I definitely think we're going to correct 20% or 40% here because of this. I'm just interested in trying to figure out the direction. And to me, the direction has changed, and it's changed now that, instead of buying dips and selling rips, I feel like you should be, selling rips and no longer buying the dips.
Okay. All right. And maybe it is unknowable. I was just trying to get a sense for, does history suggest that, these little outbursts in volatility, do they play themselves out relatively quickly, or is this like a secular shift where we could expect, quarters or more of this, but maybe we just don't know?
Well, I don't think we do. And I think it'll depend on the economy. So if the economy ends up being stronger than everyone expects, it'll probably be a short-lived affair. We might get a little bit of volatility uptick, stock market corrects 5-10%, and then everything's fine and we go on. Having said that, if the economy rolls over, we're in a situation where people aren't protected, they haven't been buying puts, it starts feeding on itself, we get higher volatility, starts causing a self-fulfilling prophecy of higher volatility because all the market makers are short gamma, and it feeds on itself. So it really does depend ultimately on the underlying economy and the conditions going in. Now, having said that, one of the things I did want to highlight is there's an increased amount of traders out there that are engaging in this thing called the dispersion trade. And the dispersion trade has been an absolute winner for the last few years. And what it is in kind of, let me figure out how I can explain this best. The classic dispersion trade has traders selling index vol, meaning that they're short the volatility of the index, and then buying the volatility of the underlying stocks. So they buying options in those. So if you get a situation where some stocks are going way to the moon and some stocks are getting crushed, meanwhile, the index isn't really going anywhere because the two kind of offset each other, you can have a win in that your volatility that you've sold on the index is limited, and yet the volatility that you're long on the individual stocks is actually done great because those stocks have moved up and down. And if you think back to 2023, it was just the ideal environment. You had the Mag 7 just ripping and a lot of other things going down. So the index really wasn't going as far and as fast as everyone thinks. A lot of days you'd get up and the Mag 7 would be up and then energy would be down and the index would be kind of meandering around. But meanwhile, the action on those two sectors was huge. And so we've seen a situation where this dispersion trade has become more and more popular. And one of the things that I worry about is that whenever a trade gets more popular, more capital is attracted to it. And, you get this crowding effect. And I hear when I talk to other traders, that are in this square, they all say, oh, don't worry about those guys. They're the smartest guys in the world. They understand all the risk. And it just harkens back a little bit to like long-term capital. And how many times have you heard, no, don't worry about those guys. They're the smartest guys in the room. And if everyone thinks that, that they're smarter than everyone else, it could just be a situation where this trade gets crowded. Now, what happens if this trade gets unwound? One of the things that I believe that we should all be aware of is there is a chance for increased volatility in between sectors that we're not expecting. And I'll go back to the quant crash. There was a quant crash, I think it was in 07. And for most people, it wasn't a big deal. It was kind of a specific thing where the value stocks that all these guys were long got crushed and all the stuff that they were short went to the moon. And yet, if you were an AQR or if you were a Goldman Sachs, quant hedge fund, this was a really stressful, very traumatic period. And what I'm worried about a little bit is that we could see the same thing with the rapid unwind of the dispersion trade. And because this is a relatively new trade, like it's been around forever, but it's never been this profitable and it's never been this widely put on across the whole street. Jem Carson, that option guru, I think he said something like there was more than, I think, is it 10 or 20 pods? 10, I think it's more than 10 pods at one of the big shops running dispersion models only. Like just that one trade that these guys are all doing it. And so I just worry that there's those kind of unwinds that we're not expecting, things that people aren't talking about. I worry that that could come out and bite us in the butt. Like that's the kind of surprise that I'm worried about.
And just put an order of magnitude on it. If that were to happen, is that something that could bring the market down by double digits, or is it really located to just certain parts of the investing class?
I actually think that there could be an accident there. I don't want to say for sure because I'm not for sure. I just think it's one of these things that it's off everyone's radar. When everyone's worried about something, I say, "Oh, great! Now I don't need to worry about it because everyone else is worried about it, and the
Right.
market's kind of already corrected and anticipated it." I'm actually more worried about the things that no one's talking about, or the things that they tell me not to worry about because everyone's smart. Those guys are smart and they'll never, have problems with it. And I guess if I was thinking about how to play that and how to protect against an unwind of the dispersion, at the end of the day, they're actually short index vol. And one of the things I think you could expect to see is a big bid in VIX, the volatility, the S&P volatility index. So I'm kind of keeping on the lookout for that. My background is an institutional equity derivatives trader. I was short volatility my whole, working life. And it made sense. I had a bank behind me. I could actually trade the gamma. Historically, implied volatility traded above realized volatility. So it made sense for us to be short. I am not naturally one that is prone to being long VIX. If you look at the kind of the return profile of owning VIX over the long time, it's one of the worst trades out there. And in fact, it's hard for me to make a case that you shouldn't be short, in a proper amount if you were actually looking to allocate capital and endowment and stuff. Having said that, I really don't think that this is the period. I think that there is a lot of chance that this dispersion trade comes unwound and unglued in an unruly way. And VIX is something that I actually own, and I rarely own VIX.
Okay. So this is interesting because you're basically saying, look, I'm a professional who basically spent their career shorting this thing, and I'm actually long it right now. So
Correct.
it's adding a lot of weight to that decision of yours. Okay. If you don't mind, let's just take a quick tangent. You've mentioned a
Sure.
term a couple of times that I'm going to guess most listeners don't know what you mean by it. So when you talk about gamma, can you just give the quick description of that?
Sure. So gamma is the change in delta over time. So if you take an option and you are a market maker and let's say it's at the money, you will go and the delta will be 50, meaning that if you short 100 shares of this option, you have to buy 50 shares of the underlying to hedge it. And then as that delta changes, as that option becomes more or less out of the money, that is the gamma. So the amount of gamma that a market maker needs to hedge will vary on the type of option and the maturity and the strike of the option. But in essence, that is what creates this chasing effect. So I'll step back and just talk about market makers. If they are long gamma, that means that they are long an option, and then they are short the underlying. When the stock goes down, they're able to buy back the stock that they sold against their call option. So in essence, what happens is that they reduce volatility. So they buy a call option, they short half of it in terms of stock. Stock goes down, they're able to buy back the stock that they shorted, and then they're just long the call. And then if it goes back up through the strike, they'll be shorting more because they're long the call, and they'll be shorting more. So they're selling rips and buying dips. They're going against the market moves. Now stop and think about it if they're the other way. If they've sold that call, so at first they need to buy some stock to hedge it in case the stock keeps running higher. They need to sell it. But then as it goes down, they say, well, now that call is going to be worthless, so I better sell that. I better sell my call, some of my delta that I own. So they're selling it as it goes down. And then what happens if it rips back up? They got to go and they got to go cover it again, and they got to buy it higher. So one of the big changes that kind of has occurred in the last decade that a lot of people before this didn't realize is that the market makers positioning in gamma actually has a self fulfilling effect on the volatility of the index or the whatever, security they're trading. So if you are the JP Morgan whale, there's this very famous fund out there that rules this option at the end of every quarter. Everyone knows what it is, and everyone knows the strikes, and everyone sees it. And Adam, this trade is so large. One day I went and did the math, and I was trying to figure it all out, and I was doing all my spreadsheet, and I was off by $1 million, and I couldn't figure out. I was like, what the heck? I can't figure this out. Why am I out by $1 million? And then I realized that was the rounding error. Like, that's how big this trade was. It's just massive. I was like, oh, that's just the rounding error. So this trade is so massive that it actually has it affects the market. So what this JP Morgan trade does every quarter is that they buy a put. Okay, I'm going to keep it simple. I'm only going to talk about the put they buy, but they actually do sell another put way down lower, but that's almost irrelevant. So they buy a put, and then to fund that put, they sell a call out of the money. So as the stock market rallies up to the call that they have sold, all the market makers are able to sell deltas, meaning they're able to sell the stock market against that call. So as it goes up into there, you see the situation where around the strike of that call that they sold, it's actually not very volatile. Because if we think about what those market makers are doing, every uptick they sell, and then if it dips back down, they buy it. And so this is why often when you see the stock market rally up into these things, up into events and stuff rally towards the end of the quarter, it gets really quiet. And the reason it gets really quiet is because the market makers are all long gamma, and that they are, in essence, creating the quietness of the market because they're able to go and provide liquidity both ways. Now, contrast this to when the market sells off and these market makers are short the put to this index, to this client. They then, instead of selling rallies and buying declines, they're doing the opposite. They're actually selling declines because they need to hedge more as it goes that way. And then they're buying rallies because they have to buy back their calls. Buy back their deltas that they're short. Long and short of it is, the important thing to remember is a big client can actually affect the volatility of the underlying instrument that they're trading by either buying or selling options.
Okay, thank you. So that helps understand kind of the gamma dynamics. But what I took from you there is, the markets in general, have been on this nice move higher, especially in the past year and a half or so, and things have been really quiet. And one of the reasons why they've been, or not volatile, it's been a peaceful rise. And a big part of that, it sounds like, is these big players are contributing to that quietude as they are playing the gamma game that they're currently aligned for. Your concern, if I'm right here, is that if the market dynamics change and these guys are all of a sudden on the other end of that gamma trade, their actions are actually increasing the volatility that's there. And so you could get really big kind of wild market moves that a lot of people are unprepared for.
That is correct. And then back to the dispersion trade, one of the things is, as the stock market has rallied, it's made the dispersion traders even more, it's made that trade even more profitable. So they've done more of it. So they're also contributing by selling index vol and doing more, and buying individual stock market vol, like buying NVIDIA and buying Exxon and buying volatility and those things. So they are, in essence, also creating a self-fulfilling feedback loop where the index ends up being quieter. And we eventually get to a point where it's so quiet, it's so cheap and then finally something happens to break it out of the thing, and then nobody's positioned for it, and it becomes a feedback loop the other way.
Okay, and I don't want to be, unnecessarily alarmist here, but is this, trying to get the right analogy, is this sort of like the forest that's just building up more and more dry tinder over time, so that when a spark does happen, it creates a big conflagration? Is this a ticking time bomb, like it's an inevitability this is going to happen, or do you have a different analogy folks should think of?
Well, I think it's a little bit of both. It could also be like it doesn't have to happen, but there's no doubt as it continues and as it grows and as more capital is deployed to those strategies, it increases the likelihood that the prices are sent to levels that make no sense that then would feed back the other way.
Okay.
Like so
Oh,
the longer it goes where it works and causes more people to chase that strategy, the more likely it is that the actual uh, unwinding will be disruly.
okay. So we'll get further in this discussion to sort of like your positioning and the
Sure.
strategies and assets you like. But um, if the trend continues this way, if your concerns continue to mount, could there be a point where, in addition to just betting on increased volatility, you're starting to do things like either reducing your market exposure, like I'm just moving to cash because I'm worried about the market, or maybe even flipping on the short side and saying, I think the probability of this is now big enough that I'm willing to take short positions against it.
Well, I'm already there. Like
You're already,
I'm already betting against a lot of stuff. So I
okay.
will have some longs, but I think right now, if I had to look, I am net short.
Okay. All right. Okay. Maybe.
Now, don't forget, I'm a shorter term trader, and this might change in a week. You know, like as my idol Druckenmiller says, ask me next week. It'll be completely different.
Okay. Um, Obviously, I got to dig into that with you, but real quick. So back to the first thing you said in your first answer, where you said, "Hey, the global economy might be surprising to the upside." Um, Talk about the reasons for why you see that. I've talked to some folks recently who have said, "Hey, China looks like it may be picking itself back up a little bit better than folks had expected." Where else are you seeing the upside surprise?
Well, I think first of all, you just have to look at the U.S. It's continually surprising to the upside. Just rewind a year ago, everyone thought we'd be in a recession. Everyone thought that we would be already cutting rates because the economy would have rolled over. And yet, time and time again, the US economy is stronger than everyone expects. And I am actually, if you think about what I'm worried about, I'm actually more worried about the US economy continuing to be strong and the consequences from that than I am worried about the economy rolling over. The US economy rolls over, we're going to get a shallow recession. The Fed's going to cut rates. Yes, the stock market will go down, but on the whole, we're probably going to be able to deal with it. The Fed's got a lot of room. All of a sudden, we won't have the pressures from inflation because the economy is rolling over. And let's face it, rates are fairly high. We've seen this before. We know how to deal with it. The really scary story to me is an economy that refuses to roll over and inflation actually starts to increase from here, and all of a sudden that long end of the bond market needs to be repriced for a completely different reality that they're currently expecting.
Okay, and so why does that concern you so much? So let's do that. There's a bear steepening, long end of the curve comes up. Um, what specific fallout effects are you worried about?
Well, ultimately, I think it comes down to the equity risk premium, which is the difference between what you pay for earnings and the interest rate. And although over the short run, that equity risk premium doesn't really seem to work, over the long run, it is actually very effective. And I think that what'll happen is as rates start to go up, it'll take money out of the stock market, and actually investors will be moving into fixed income. Howard Marks, the legendary investor, had this great piece about the fact that for the first time, a lot of these pensions can hit their bogey, which is 8%, through fixed income.
Hmm.
And he says, well, what's his line? It's something like, equities are stories, fixed incomes are contracts,
Mhm.
meaning that like it's no longer so much like a story that has to work. It's actually a contract that you're going to get this return. And I don't think that this is the end of the world. I don't think that the stock market's going to crash from it. But on the whole, I suspect that as rates go up, it will pressure the stock market and ultimately people will pay less. Like right now, we're paying almost 21 times next year's earnings for the S&P 500. Is that really appropriate if the 10-year goes from 4.5 to 6? And I would suggest that no, it's not. And it doesn't even mean that the economy, like if the economy could keep going, we could have continued earnings growth and the stock market could still go down just because the multiple that we're ascribing to that earnings stream changes.
Right. Although we probably could have an interesting discussion as to, even if rates just stay where they are those current multiples justifiable or not? Because they're higher than historical averages.
For sure. And I'm not going to disagree with you there, but it'll be especially tough if we get a situation where the bond market is backing up in yield.
Okay. I just want to dig on this question a little bit more just to make sure I understand your concern. So, um, got it. There's concern that stock valuations would get negatively affected by a bear steepening of the rate curve. Is your also concern just that, hey, with that much additional kind of gravity pulling down economic activity, that those higher rates would leave us vulnerable to a deeper recession than the shallow one you would expect if we went into a recession now?
I'm not as worried about that, but I do worry a little bit that maybe let's imagine that the Fed goes and the economy heats up. They don't raise rates because of the fact that they're worried about the election. And even though everyone tells me that the Fed's not political, I don't buy it. They don't raise rates because of the election. And then all of a sudden, after the election, they panic and raise rates more quickly than they should.
Mm-hmm.
Then that could be a situation that, like you just said, but I don't think that's going to happen. I actually think the Fed talks a good game. Everyone thinks that Powell doesn't want to be the next Arthur Burns, blah, 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 blah. If you actually look at his actions, he wants to cut. He wants to be dovish. I think it's going to be hard pressed for them to raise rates even after the election, unless inflation's running a long way, like a lot higher. And so therefore, I suspect that what's more likely is that the Powell and the Federal Reserve aren't as important as the long end, and the long end eventually will cause a repricing of financial assets. But I'm not as worried about the actual economy as as you just implied through your question.
Okay.
So no, I'm not worried about the economy collapsing. And ultimately, the reason I'm not worried about that is because I believe that there's way more fiscal stimulus in the pipeline than most people realize. And that ultimately that is driving more so than rates what's happening. So if you told me that the next president came in, pulled back on the Inflation Reduction Act, and was about to try to balance the books, then I would be the first one to say, no, honestly, if I like, that would be the thing that would get me the most scared about the stock market. Because ultimately everyone hates and talks about the problems with the deficits. And I'm not here to judge whether the deficits are right or wrong. They are what they are. But one thing that people don't realize is that the government's deficit is the private sector's credit. So that money is actually turning into profits. Like you can actually see that relationship if you look at the government spending versus profits. And part of the reason that the US economy is doing so well is because the US is running the largest deficits. And that's just the reality of the situation. So if you were to tell me that those deficits were going to decrease, that would actually make me more scared about the economy than if the Fed raised rates 25 basis points.
Okay. We live in such a crazy world now, right? Where like, the argument for being bullish on the markets, which of course every market participant wants the markets to continue to do well, is largely predicated on just wanton, irresponsible spending.
Right. Well, and to Adam, and one of the things you say, we live in a crazy world. And I think that's an important point in terms of how the world has changed. And it goes back to this idea that from 1982 to 2020, we relied almost solely on monetary stimulus to affect the economy. So there, if you go back to that period, then the Fed raising rates would in fact be very worrisome for the economy. It would be very scary for the economy because we were so dependent on the private sector money creation, meaning that that was it. The government was trying to be more neutral. Now the government is actually the driving force of this last, expansion. And I think that people continually focus on the monetary aspect without thinking about the fiscal aspect enough and how much the world has changed. So I'm much more interested in where the fiscal stance of the government will be in terms of trying to forecast the economy at the very least than I am worried about what the Fed's going to do.
So I'm going to reveal something after I ask this question, but I'm curious how seminal is this shift? Like how is this a Rubicon that we've crossed, right? Where now all of a sudden fiscal stimulus can become a cure-all for lots of things. And it appears to be sort of fast switching from emergency measure for a global pandemic to just a tool we use for whatever we want to use, right? So how dangerous is that we've let this horse out of the barn or this lion out of the cage?
Okay. Well, first of all, a good trader never says never. So I'm not going to tell you that this is for sure the switch. Having said that, I do think that the odds favor that this was a seminal change in the way that we think about things. To me, it's kind of the anti-Volcker 1982 moment. Back then, there was all sorts of worry that we wouldn't be able to stop inflation. Volcker came, he crushed the back of inflation, and from then on, we had this ability to use we didn't just have the ability, we solely used monetary means to try to affect the economy, and we did a good job of doing that. Then 2008 hit, and what occurred at that point was we kept trying to stimulate with monetary means. And when you stimulate with monetary means, you in essence force the private sector to take more and more debt. We hit a point where the private sector couldn't take any more debt. They said, no, thank you. We're going to put rates to zero. They go, we don't want any more. We don't want to take out any more loans. We're more worried about paying back our existing loans than taking out more loans. We tried extraordinary monetary measures, quantitative easing, Operation Twist. At first, we were really scared about the inflation this was going to create. In hindsight, it didn't create any inflation. Then we came to 2020, COVID hits, and everyone's like, oh no, we're in trouble. There's no way that we can get out of this. And they say, but wait, you know what? We learned from 2008 that monetary means on their own don't work. So we're going to do some fiscal. I happen to think they did way too much fiscal. And the reason they did way too much fiscal is because we got such high inflation.
Right.
I think it's that simple. But having said that, I do think that the genie is out of the bottle in that they created this willingness to spend. And if you think back to 2008, Obama wanted to spend, and then all of his advisors told him, we can't do it. It's going to cause a financial crisis. You're going to make everything worse by spending. And you're going to cause, like there was the famous Reinhardt and Rogoff book, This Time is Different. They predicted all sorts of, absolute terrible things of the government spend. So the government actually did pro-cyclical fiscal cuts in the wake of the GFC. So they made the problem worse. Bernanke was begging them to do some fiscal, and yet they were actually cutting back. Yes, you'll see that the deficit went up, but most of those were automatic stabilizers. In terms of their actual spending, the discretionary spending, they were cutting back in trying to balance the budget. 2020 hits, COVID hits, we decide, no, we're got to do this fiscal, and we've let the genie out of the bottle. Like, it's amazing to me how much they did, and it's amazing that we're not more worried about this in terms of the reality is that we created this inflation, and everyone's just like, oh, don't worry, the Fed's going to mop it up. And I might even argue that the Fed can't mop it up, that their tools aren't nearly as, no, their tools aren't as effective as they think they are.
No, I'm laughing because fiscal conditions are looser today than they were when the Fed started its rate hike regime.
Yeah. And there's some argument to be made that the Fed actually raising rates might have a negative effect. It could actually be stimulative. And the reason, like, that sounds insane, but if you think about it, everyone locked in their mortgages. Not everyone, but a lot of people locked in their mortgages. A lot of corporations locked in their funding. So when the Fed raised rates, what are they really stopping in terms of people that are changing their behavior? Because ultimately that's what the Fed's trying to do by raising rates. They're
Right.
trying to stop you from taking out a car loan. They're trying to stop you from going out and buying a new house. But a lot of the problem was that a lot of the big ticket items were actually already locked in. So there was very little pain felt with the higher rates. And then not only that, if you think about it, as the Fed raised rates, who is the biggest debtor out there? It's the government.
Mm-hmm.
And the government is not changing their spending based upon those higher rates. And in fact, they went and did more with the IRA, the CHIPS Act. They doubled down on their spending. So as they raised rates, they create a larger deficit. And I've just told you how I believe that the government's deficit is the private sector's credit. So that actually means that the private sector, because of the higher interest rates, has more money in their jeans. And I know that's kind of crazy, and everyone thinks, but wait, the higher rates means that you don't buy a house. And yes, there is no doubt about it. A lot of some private sector money creation has been hampered by the higher rates.
Mm-hmm.
But at the same time, there's also this other effect where the money that's getting pushed into the system because of a higher government deficit is actually helping the economy.
So I agree with that to a fair extent. It's like most things in our current economy, it's not evenly distributed, and I think we can say, it's unfair in many ways. Where, hey, the people who own that debt, all right, are getting paid, that government debt are getting paid now a nice return on it, right?
Right.
And a lot of the monetary, but certainly the fiscal stuff that's been going on right now too, is helping support asset prices, and that rewards, again, the folks at the top of the pyramid. Now they spend more per capita than the bottom 80%, if you will. So we got to ask ourselves, yeah, maybe it's stimulative to a certain extent. Is that good? Well, at the same time, it's diminishing the prospects of the bottom 80% who aren't getting that boost, but having to deal with the higher cost of debt, right?
Right.
There's
I completely agree.
And those people are spending, so that goes into corporations, which is stimulative to their profits. But at the same time, those corporations are facing the debt maturity wall, and so they're going to be hampered by that. So on a net basis, not entirely sure what's going to happen here. I don't get the sense that you're arguing that, oh, we should just do a lot more of it because it's this massive stimulus. But it's a complicated factor that I think in many ways makes a lot of things worse. And I'd love your thoughts on this, which is, a lot of people who are saying, well, we're now in an era of fiscal dominance, right? Where what matters of the two levers right now is the fiscal part. And because of that, and because we're not containing our spending, the Fed is watching the government's interest expenses, and at some point has to make a choice. And in a pure era of fiscal dominance, the central bank generally has to give up its inflation mandate just to try to help in the servicing of the debt costs. And if that were to happen, that's not net good for the economy in the long run either, if you've got resurging inflation.
Oh, I completely agree. I think that's a long way away, though. I don't think, and the other thing is that you said something about, I don't think you're saying this is a good thing. One of the things that I like to do as a trader is like, I'm not here to debate what we should do. Like, who cares? Like, we and I could have all the opinions in the world. No one's going to listen to us. It's not like the government's going to change. I'm more interested in what they will do than what they should do.
Right.
And
Especially
so,
as an investor, you're just going to
right.
trade the reality we have. Yeah.
Yeah. Like, no doubt when I go vote for whoever I'm going to vote for, I'm going to let my own opinions do. But when I'm talking about stuff, I have zero interest in debating about what the Fed should do, what government should do, because it's not going to change anything. I'm more interested in trying to figure out where the puck's going, like Wayne Gretzky said, than debating about where it should go. And so from that perspective, I think it's important that we just go, hey, I might not like this. I might hate the fact that we're doing all this spending. I can sit here and rail about it and talk about how it's the end of the world and stuff, or I can just go in and, and adjust my portfolio appropriately. And that's what I'm doing. I'm just like adapting to this new reality. Um, I'm sorry, I've forgotten the second part of your question.
And it was more about fiscal dominance, about the Fed.
Oh,
Do
that's
you
right.
think we'll
Whether it
get,
was going to ever end. Yes.
okay.
I think we're a long way from that. One of the things that I'm watching for is for the bond market to eventually get into trouble. I love Bill Fleckenstein's line. He says, eventually the bond markets will take away the keys.
Yeah.
And
Or they will take away the printing press. Yeah, exactly.
yeah, maybe it's changed to printing press because I don't like the word printing press because I feel like that's overused and people used it during the QE time
Mhm.
between, and it really didn't do anything. And I'm not sure that's correct. I just like the take away the keys. I think that's a great line. And the question is when that is and how far along are we, and are we actually close to that? And I guess that's where I differ from a lot of people because right now overnight Fed funds is 540 or 530 or something like that. And yet the 10-year is what, 440 or 450, meaning that the 10-year right now is still anticipating lower Fed funds than
Mhm.
we're currently at. And if you look at things like the term premium, which is another way of looking at how much it's costing the Fed the Treasury to fund their debt, it's still relatively well behaved. So I have a lot of trouble with people that say, "Oh, we're at this Rubicon. This is like the moment where fiscal dominance is taken over, and this is like the end of the world." And I go, "Well, if they were really that scared about it, I would expect the curve to be super steep. I would expect them to be scared about future inflation. I'd expect if Fed funds was 540, I'd expect like the 10-year to be 7, 8. Like at that point, we can have those discussions and talk about it. But right now, they're still assuming everything will be okay. Like there's still very little concern out there. Yes, there is like some loud FinTwit types that are talking about it,
Sure.
but let's just talk about like the real money. Like go and watch like what JP Morgan's fixed income guy says on Bloomberg. And they're not talking about these things. And in fact, they still think that we're going to have kind of a return to the pre COVID era of 2% inflation.
Mhm. And
And
just sorry to interrupt, but I mean,
yeah,
several of the folks that I interview who I have a lot of respect for, Lacey Hunt being, right at the top of that list, they will walk you through the math that says we're definitely getting there. So it's
but
not
to
a
what math? I'm
crazy
sorry. Could
argument.
you? So the we're definitely getting there in terms of interest rates and inflation going back down to 2%.
Yeah.
Yeah, and ultimately, I think that the where I differ from them is that I think that they keep assuming that that the government won't be able to keep up with their spending. And I'll go back to Adam. Like I was actually a big bond bear even before COVID. And I used to hear these things about the triple Ds. I'd hear like, there's no way inflation can go higher. And they told me this in all earnesty. I'd have real serious hedge fund guys look me in the eye and go, there's never going to be inflation. Like we all forget, but that was the common belief pre-COVID. We're never going to have inflation because of this. Demographics, debt, meaning there's too much debt, and
Yep.
then disinflation because of technology. So they thought it would be impossible for us to have inflation. They literally said that. And I always pushed back and said, no, if the government has the political desire to spend, they can overcome those things. So I will be the first to say that those tendencies we're disinflationary forces. But if the government spent enough, which we saw in COVID, they can create the inflation. So ultimately, always inflation is a political choice.
Right. And what's interesting is, and I've said this a lot recently, I interview a lot of people every month on this channel, probably like, I don't know, 30, 40 people a month. And of every topic, inflation is the one where I see the greatest disagreement right now. Lots of smart people on one side, lots of smart people on the other side. And I'm not pushing for one or the other. I can, depending on who I talk to, I get basically swayed by the most recent person I talked to. So you're making me, but
Well,
I know with Lacey and Steve Hanke, both of whom are accomplished economists, their argument is largely rooted in the change in the money supply.
but I think the government can spend and create the money supply.
Oh,
Growth
sure. I don't think they disagree with it. They're
Yeah.
just looking at current trends in the money
Oh,
supply
for
and
sure.
saying,
I get it. I also think the other problem with about using the money supply is that the money supply as we know it has changed. It's difficult to measure. And the M2, it is, there's lots of different types of money, different types of credit and stuff. I think that is difficult to measure.
Yeah, no doubt. And I think
Yeah.
Lacey even, he looks at M2 obviously, but he uses ODL, other deposit liabilities. That's sort of his, what he thinks is the better proxy. But you're right. Everybody sort of has their own flavor. And again, I'm not here to argue one side or the other.
No, fair enough. Yeah.
No,
That's what makes a market.
All
We
I'm
need
saying
someone
to
to
your
trade
point,
against, Adam.
yeah. Well, that's what makes a market. But
Yep.
but all I'm saying is you were saying, hey, some people have been told me that it's just not going to happen for reason X, and I'm like, a lot of those arguments aren't crazy. Now we're going to find out who's right. One of these camps is going to be right. I don't know which one it's going to be, but it's fascinating to me that this is one of those issues where you can have really smart people, arguing facts on both sides, but come to very different conclusions.
Right. But one of the problems though I have with that is that if we do get a situation where the government reins in their spending and tries to balance the books, and then inflation falls, they'll go, look, we were right. And I'd be like, I never once disputed that if we went to an environment where we were trying to balance the books and we were cutting back on our fiscal spending, that we wouldn't have less inflation. So the crux of my argument is that we have to have continued expansion in terms of fiscal stimulus. And that's why your question earlier about whether this was a seminal moment, a difference in change, although I'm always on the lookout that I was wrong, I do believe it was a difference in change. And I do think that we're not going back. Like, just look at these two presidents. Both of them are just campaigning on the idea of spending more. There's no talk about balancing the budget, right? Like Nikki Haley tried to run on that and she was shot down.
Right. And this largely underscoring why I asked the question in the first place, because I'm right there with you on this, Kevin, which is my big worry is not only do we cross the Rubicon and we put this new tool in the hands of the most irresponsible people around, right, which are politicians, right? Super short-termed focus, super, absorbed with making themselves look good, and whatever the repercussions are, that's someone else's problem after I'm out of office, right? But we have shown the populace that they can get direct stimulus the next time things get bumpy, right? So not only will the politicians feel pressure to act and want to spend to make themselves look good, but the populace is going to say, wait a minute, you gave it to us last time, give it to me this time, right?
Completely agree with you, Adam.
Yeah. So it's I don't know. Anyways, I told you I was going to give you a reveal. So I did an interview a few weeks back with Thomas Honig, who was used to run the Kansas City Fed, and he was a sitting and voting member of the FOMC. And this was back during the Great Financial Crisis. And he actually has the distinction of being the lone dissenter during the period where they were debating whether to do QE. He was the one guy voting against it. Bernanke was trying to get a uniform vote, and Honig kept sitting out for all the reasons that you and I would have probably voted against it ourselves as well. Like all the warnings he raised all came to pass, right?
Right.
The debt expansion, the wealth disparity, the increase in the cost of living, just all that stuff, right? So he said to one of your earlier points. He didn't. The words "the Fed is politically driven" didn't come out of his mouth, but he basically said the pressures that the Fed feels most acutely are those coming from Capitol Hill and from Wall Street, right?
Oh, yeah.
So very much, a factor in their decision making, right? And secondly, he said that as we would fear, the Fed, the decision making process at the Fed, especially in times of kind of crisis, is let's do something, and then we'll figure it out how to make it work later on, right? So there's this bias of so it's a very sort of short-term optical, like let's just look like we're busy. We're going to make a policy change, and whether it works or not, we'll figure that out later on, right?
Yeah. Oh, and listen, I sometimes I cut the Fed breaks. Other times I'm actually very critical. One of the things I'm very critical about is the fact that we use QE as a policy tool. We say, okay, the economy is doing badly. We need to, do some quantitative easing. And we did that in 2008 and 9. We did that in 2020. Yet we never use QT as a policy tool. And I still contend that instead of raising rates by 50, 75 clips, at a time, bips at a time, if Powell had been saying, okay, we're raising rates 25, and by the way, I need a bid on $500 billion of 30s, the world would have been a much different place. And actually, we would have all been better off. If I was at the Fed, I would have been pushing to use not only interest rate hikes as a method to slow down the economy, but I would have been pasting bids left, right, and center with QT. I don't see why I don't buy this argument that you use it as a policy tool on one side and then you don't use it as a policy tool on the other side. I think it's intellectually dishonest.
Yeah, well, and he's even talking about moderating QT now that the reverse repo program is almost empty, because right now, this is a whole other discussion, but
yeah,
a lot of the folks I talk to say, one of the things that's kind of kept us out of recession, why that recession didn't materialize, is because the net liquidity flows have been so positive since October of 2022, which is when the market bottomed and, GDP and asset prices started going back up again as strongly as they have.
Can I just interject another thing
yeah.
for there? David Zervos has talked about this, and I agree. And I've talked about it a little bit about from a Japanese point of view, but David Zervos from Jefferies has recently highlighted how we're going to stop QT and we're going to end with a balance sheet, a Fed balance sheet of whatever trillion it is. That is forever debt. Like that is never coming off.
Yeah.
Right. So in essence, what that means is that everyone sits there and worries about, we have all this debt, but it's some of that's going to sit forever on the treasury. At the Federal Reserve. And like I go and I look at Japan and everyone talks about the fact that they have 250% debt to GDP outstanding, but yet half of it is held at the Bank of Japan. And if I told you tomorrow, like that, we're going to just in the middle of the night, flatten those two pieces, like we're just going to like take the long and we're on short and we're going to rip it up.
Yep.
Nothing would change in their economy. Nothing. Like it's like, and so it really does kind of, once you start going down that road and thinking about those things and thinking about it, you're like, oh geez, you know what? Like money as we know it isn't really exactly how we think about it. And it's much more flexible and we can do funny things with it. And to your point, ultimately, the politicians are going to do the wrong thing. And like when I think about ways to bet, I'm more willing to bet on them making a mess on the inflation side than I am about them getting to target and staying there.
Got it. Okay, well, let's get to that because I do want to get to kind of like, as an investor, how are you looking at the current landscape ahead? So, on the inflation side, we just had, March inflation come in hotter than folks wanted. We've had Powell out this week talking about how, it might take a little bit longer than we thought to get inflation under control. Obviously, market's already been having to kind of ratchet down its rate cut expectations all year. what kind of year do you see ahead from your inflation viewpoint? And, based on everything that we've talked about, what assets are you looking at right now besides long volatility?
So I am an inflation bull, as might be expected given what I've just told you,
Yeah.
meaning that I continually believe that inflation will surprise to the upside. And I think we've seen that in the last three inflation prints. They've ended up being much higher than they've all expected. Um, when I think about like how to position for that, what to do about that, one of the trades that I love is to be long inflation break evens. And an inflation break even is long tips. And the trouble about a tip is still a bond. So what you do is you get inflation plus the bond portion. But if you go long inflation break evens, you can actually isolate only out the inflation portion, meaning you are just betting on inflation. So if you go long inflation break evens at 2% and you hold it for 10 years and you hold it till maturity and inflation ends up being 4% over that period, then you will make 2%. You will, in essence, make the difference between where you went long and the actual realized inflation over that period.
Mm-hmm.
So that's one trade that I believe very strongly in. I think that eventually what will happen is that governments throughout the world will realize this is insane to be issuing tips. Like, I think it's nuts. Like, why are you issuing a security that is potentially a huge liability? In Canada here, I'm a Canadian, and they've already cut back and actually stopped issuing what they call real return bonds, which are tips. So I think you could actually get a situation where there's a repricing of long-term inflation expectations in terms of the tips market because there's just a scarcity factor. So that's one trade that I love to do. The other thing I'm very partial to gold. Having said that, I'm not long gold because of inflation. I'm long gold because of the demand from central banks. And I've been saying this for a while, and it's done me well in that I've been able to own gold even as interest rates have been going up and even as the US dollar has been going up, because I kept stressing that it's not a story about interest rates. It's not a story about the US dollar. It's a story about central banks buying it. And ultimately, why they're buying it is because they saw the Russian central bank have their FX reserves basically zeroed by Western countries when they invaded Ukraine. And if you're sitting there and you're the People's Bank of China, controller, and you're sitting there and you're looking at the tons of reserves and FX reserves that you have on your books, you'll say to yourself, well, geez, you know what? This could happen to me, and I better start at the very least diversifying away from those US dollars. And it doesn't mean that I'm going to get rid of all my US dollars, but it just means that it's prudent. Like, it just makes sense given this risk to start buying some other assets. And ultimately, gold is nobody's liability. When the People's Bank of China buys gold and gets it and, owns it in their vault, it's nobody's liability. And so when I look at their FX reserves, I said it makes sense for them to be buying and gold continually for the next year, 10 years, 5 years, 10 years, whenever, because they are going to continually be diversifying a portion of their FX reserves into gold. So I've been very bullish on gold, but it's been more so because of the central bank than it has been about the inflation.
Got it. And sorry to interrupt, but I want to just get your comments on this chart here. So this is a chart of the performance of the XAU, the mining index, versus the price of silver and the price of gold. And I got to say, it's been pretty shocking to me how poorly the miners have been performing. And yeah, they've jumped up a bit here of late, but their overall returns are still pretty meager relative to how the metals themselves have performed. And this sort of in generalizing here, but I kind of feel like either the prices of the metals have to fall hard pretty soon, or else these miners should, I think, be mathematically poised to take off from here. Do you agree, or do you have a different outlook?
I agree. Can I actually share my screen? I got some charts here that we can go through here.
Absolutely.
Okay, so let's grab it. Okay, so I spoke earlier about how the central banks, and they're mostly Asian central banks, are buying gold. And one of the things that's being kind of interesting about this is that when you've watched the performance of gold as it trades in the different sessions, you'll notice that actually a lot of times you'll get up, it'll be up $20, $30 overseas, and then it'll get sold down in the US session.
Yep.
And the reason is because, as I explained, the real buyers are actually overseas. They're not us. Like, there's very few, like, and I want to put aside the last couple of weeks, because it is true over the last couple of weeks, some people have gotten excited about it, and we've actually gotten some buying here in North America. But prior to this, it had been mostly overseas and the Asians that were actually pushing it higher. Okay. And we see that if this chart that I have is actually the MUFG, I guess that's a bank in Japan. It's the physical gold ETF. And that's the orange line in terms of the number of shares outstanding. The blue line is the number of shares outstanding for that ETF. And then the orange line is the GLD. And so the GLD, in terms of the number of shares outstanding, has actually been decreasing, meaning that people are selling that product and actually gold is coming out of the vaults for the GLD. Yet in Japan, it's going straight up. And it's going up to the point where I've actually got a chart, and you'll see that it actually is traded at a premium to the NAV. Let me just grab this chart for you here. Where is it? Blah, 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 blah. Can you edit again? Sorry.
Don't worry about it. I got your back.
Where is it? I'm not as good on the chart. Okay, you know what I'll do? Let me just do this 1 second. Okay, here it is. Edit back in. And you'll see here, this is the chart of the actual, the price of it versus the NAV. And the NAV is the orange line and the white is the price. So you actually saw that they was going at a huge premium to NAV. So what this had occurred is that it was no longer just the central banks, the overseas central banks that were buying it. We actually got a situation where the actual retail got into it. But this was not a function of Western companies, Western investors getting excited about gold. This was all driven from overseas. So back to your question about why the miners have done so bad. The reason that they've done so bad is because we, as Westerners, have actually been selling gold. We're not excited about gold. In fact, we're worried about rates going higher. We're worried about the US dollar going higher. On the whole, we've been selling it. So that means that we aren't buying the miners that are going to benefit from this. Now, there's also the other problem is that even though gold has been going up, the cost of these miners is actually been going up equally as much. So their actual margins seem to be really struggling. Like these guys can't seem to be able to make any money. We've had gold go up, over the last year, and yet their margins are still kind of muted, let's say. Having said that, this last couple of months, we've had a huge run. We've gone at the end of last quarter, it was 2030 was gold, 2030, 2050. We're now like 2,400. And even the miners, I don't think are going to be able to actually experience cost increase that quickly.
Right.
Right. They're not, even they're not going to be able to screw it up. They're still a few quarters away from them going out and blowing money on jets again, with the CEOs. So I suspect that what's going to happen here is that as they actually start making money, we're going to start to see some return of interest in this sector. Now, one of the things that I kind of have been talking about a lot lately is something called a series of rolling bubbles. And what that theory is that the market has changed over the last decade, maybe a little bit longer than that. But in essence, as we've all become connected, as we've all gotten access to stuff, as investors have gotten more efficient, we get these bubbles that occur more quickly than they've ever happened before. So whereas in the past that something might have taken 2-3 years to develop, it now very quickly goes up in 2 or 3 months. I think that you'll just look at AI is a good example, or the EVs in 2021, the electric vehicles in 2021. And you can see this kind of someone gets a good idea, they buy some, they go on CNBC, they talk about it a little bit. Then all of a sudden, everyone else realizes this is a good idea. And next thing you know, it kind of feeds on itself. And it's in essence going up. By the end of it, it's going up because it's going up.
Right.
Like AI, I think, is a perfect example. Sure, it's a great idea. It started off, it was a great investment. When Stanley Druckenmiller got on to CNBC and started talking about it, very few people knew about it. Then all of a sudden, you had a situation where, like, smart people look at it, other people look at it, and next thing you know, it's going up because it's attracting attention. But by the end of it, we have like super microcomputer going up. You know, what was it, 1,000% or something, like something
Right.
ridiculous. It's going up because it's going up. Now, my point is that we could have a situation where this is finally uh, a mini bubble in miners has finally started. And I go back to the idea about uranium, that, like, if you look back at uranium, it was a great story for many years. Like, I remember listening to the story going, this story is terrific. Like, it's great. And it just did nothing. And it just sat there and it was disappointing and it was kind of boring. And then all of a sudden you got this situation where it finally outperformed a little bit. And I'm gonna show the chart again. I'm gonna take over the screen here because I
Great.
got a chart of this. So you'll see with this chart of, this is the URNM, the ETF. You'll see that the blue line is the Russell 3000, just a broad, stock market index. The white line is the uranium ETF. And it went, no, they were both kind of treading water for most of 2023. Then all of a sudden in August, it took off. And you see it, that initial bit of outperformance. And that was the point where everyone kind of woke up and said, hey, look at this thing. And a lot of people at that point said it's gone too far, too fast. And yet, look what happened the next 2 quarters. It exploded higher. And so this is my point about these kind of series of mini rolling bubbles, is the mistake is always to say it's gone too far, too fast, and to hope that you're going to get a chance to buy the dip. And so when you're asking me, what do I think about gold miners prospects going forward? I love them. I'm scared to death buying them because they've run a long way. Like, it worries me, and I've been long them for a long time, so I'm luckily on side with them. And it would make more sense for me to get on here and tell you, oh, you should be trimming it. It's gone a long way, and it's due for a pullback. And trust me, that is actually a safer call from my perspective. Like, nobody's going to remember me if I make that call and they keep screaming. No one's going to remember it. But if I sit here and say to you, no, you know what? They've gone a long way, but they're going to go a lot longer. If they roll over tomorrow, I look like a schmuck. But the reality is that I've been on the other side enough of these trades that just seem to never let you in and just take off. And I've fought them. And I think that this is just the new reality of the market. When they finally do get a theme, the mistake is always to assume that you're going to get another chance at it and that you're going to get an opportunity to buy it cheaper later. And it very rarely comes. And all you have to do is look at AI. You really got no chance. It took off and then just kept going. I suspect it'll be the same on the gold miners. At the end of this quarter, we're going to get finally some positive earnings momentum, and it's going to feed on itself.
Okay, great. This is maybe a little bit of an unfair question for me to ask. This isn't unfair. Using the uranium price curve here as an analog, would you say we're still in the initial bit of outperformance phase?
Yeah, yes, I would say, or at the very least, you see, there was a tiny little dip there that you could have bought. There was a moment in the euphoria where it corrected 5% or whatever it was, and then it took off again from there. Maybe we're going to get that 5%, dip that you can buy. But to me, like, that's a very difficult thing to time. You have to be perfect to get that. And I think I'm always asking, where are the surprises going to come from? Like, am I going to be surprised because this thing, goes down 20% on me? Or am I going to be surprised because it just rips higher? And one of my favorite sayings in trading is that the tough trade is generally the right trade. And to me, it feels like the tough trade is to buy gold up here, even though it's run this far.
Got it. And where I was kind of going with this, at least on the miners, is sort of what inning do you think we're in this?
Oh, like first.
First, okay, there we go. That's
Yeah,
all I
like
needed. Okay.
this is just the start.
Okay, so just the start, what I hear you saying is, hey folks, if you like this trade, odds are you're probably not going to get too many opportunities in the future to buy in at a big discount. So, if you think you want to participate, buy your initial stake now because you might not get a chance to buy on a dip, a
Yes.
material dip.
Yeah.
Okay, so I got that. Let me ask you just a couple questions real quickly here as we wrap up. You've already described this about how previous run-ups like this work in other assets, but Wall Street loves momentum, right?
Yes.
And Wall Street has hated the precious metals and specifically the precious metals mining sector for a long time.
Right.
And if things start going the way that you think they will, and right now you were saying, hey, we're giving away our gold here in the West, right?
Yep.
Could that dynamic change because all of a sudden Wall Street wants to play the momentum game with gold? And in your answer, talk about the size of the precious metal sector, because my understanding is it's a relatively tiny sector compared to many others. And so you don't need a ton of capital leaving the big tech trade or whatever for the mining complex to like just shove prices way higher mathematically.
100%. And I think Grant Williams had that famous speech where he gave when he talked about if the pension funds that are currently allocated or back then were allocated to 0.15% of their portfolio was gold. And if they doubled it to 0.3, what that would mean in terms of the GDX and the GLD. And I can't remember the exact numbers, but it was, in essence, it was like they would own the whole GDX and then some of the GLD. And it was just, it's a very tiny market. And ultimately, even the gold market itself is very tiny. And part of the reason, if you were to say, what are you worried about in terms of that central bank buying and like what keeps you up at night? And one of the things that keeps me up at night is the fact that this gold market isn't big enough for the central bank of China. Like, I think I would still diversify into it, but the reality is that the gold market is so small that they can't actually buy enough to make a difference. I would still do it. I would still try to get 1, 2, 3, 5% of my portfolio in it. But I think I looked at it, if they doubled, like I can't remember the exact number, but let's say that their FX reserves were 0.5% gold. And a lot of other countries are like 20% gold, but let's say they were 0.5 and they went to 1. They would have to buy every single gold ounce that is mined for a full year. Right? They like, and just like stop, like there's other people who need it. It's not just them. So they can't buy every single mine. So this is part of the problem, is that it's so small that it's almost worrisome that they don't bother. Now, having said that, I think they will bother. And to your point, I think that Wall Street will bother once these gold miners start to make money. And to my point, I think that you'll see it in the next round of earnings, because finally gold will have risen too fast for their costs to rise. Like, there's just no way their costs are going to rise that much in one quarter. Yet their the actual what they're selling it for has exploded higher. And then once that happens, we get a situation where they start buying, the quants start buying, the pod shops start buying, and then next thing you know, it kind of gets the West. They turn into, instead of selling, they started turning into buying. And I think that's really where you're going on. You're saying so far it's all the Asian countries and the Asian retail buying gold. What happens when the West decides to buy it? And I'm with you. I think it explodes. And I've said this for a while. I still think there could be a chance of $1,000 up week. And I know that sounds ridiculous and nuts, but like, go look at Bitcoin. Bitcoin's had that sort of move, and so that sort of volatility is not outside the realm of possibility. These things, once they start moving, there is a lot of momentum, and it's the new reality of how stuff trades, and it always goes farther than you ever imagined, farther than it makes sense to. And I suspect that's what's going to happen here as well.
Okay. All right. Well, look, it's going to be interesting to see what happens. A lot of people who watch this channel who are invested in gold. I've shared that I've got a pretty healthy amount in it too. So I'm hopeful that your predictions here or your instincts here are correct. But whatever happens, Kevin, we'll have you back on the program to give us updates along the way if you're willing to do so. So just in wrapping up here, let me just ask just some rapid fire questions, and I got a bunch of ones I didn't get to that we'll just get to
Sure.
next time
Yeah,
around the
sure.
channel. First off, so we talked about gold, we talked about miners. Just any commentary you have on silver.
So I think part of the reason that silver has underperformed is because of what I said. It was being driven by central bank buying. And China doesn't care. You know, all these central banks don't care about silver as much. I'm not as excited about it leading the way. I don't think it will continually lead the way because central banks are what really is driving it. Having said that, as kind of the retail speculative frenzy comes, maybe you get a situation where it actually starts to lead again. But it's not longer term. It's not something that I think will significantly outperform gold.
Okay, it will not. Okay, you answer my question with that
Yep.
then. Okay. All right, and then China again. I've noticed in your recent publications, you feel like the Chinese economy has maybe got better days ahead of it than most folks think, given their stimulus programs. And I believe you are buying Chinese stocks and inflation break-evens. Is that true?
Yeah. So I think China is dirt cheap, and I do understand all the reasons that people are nervous about it. I think it's hilarious though that everyone is nervous about Taiwan and nervous about the fact that China is going to invade Taiwan. And as my buddy Louis Gab points out, he goes, "Okay, if you're nervous that China is going to invade Taiwan, then you must not own any Nvidia." And they go, "Well, what do you mean? Of course I own Nvidia. It's a great company." They go, "Well, reality is that Nvidia makes all the majority of their chips in Taiwan. So you're owning a company that, you know, you're paying top dollar for growth of a company that will be in severe problems if Taiwan is invaded by China." And so it doesn't really make sense. There's a paradox there that's kind of strange. You can't own China because they're going to invade Taiwan. Yet I'm going to pay top dollar for Nvidia because I'm not going to worry about that. It makes no sense. I think that the reality is that China's stocks are dirt cheap. Another one of my idols, Russell Napier, was talking about. He thinks the long run value of Chinese equities for Westerners or for foreigners is zero, and he's basically saying that their government is going to zero you and not allow you to make money. And although I do agree with, like, I do understand that argument, at the same time, he says if you look at a lot of long-term bottoms, a lot of points that were terrific buying opportunities, it occurred at 10 times CAPE, cyclically adjusted price earnings ratios.
Mm-hmm.
And he goes through a list of it. He talks about the great financial crisis. It was 10 times CAPE. He talks about this. And then he says, oh, by the way, China's 10 times CAPE too. So I think that China, if for anyone that's willing to stick their neck out and kind of go against the common narrative, I think it's a good buy.
All right, and how are you getting exposure to it?
Oh, I just play the KWeb or the FXI. I don't think you have to overthink it.
Okay,
You could go pick stocks if you want. You could go pick Alibaba or something, figure it out.
Yeah.
I don't know. I'm more of a kind of a broad market guy, so I will just go buy the ETFs.
You're just buying the ETFs. Okay,
Yeah.
that's where I was going. Okay, well, look, Kevin, this has been fantastic. Yeah, this is the sign of a great interview when I get through very few of the questions I wanted to get through.
Or that I talk too much.
No. It's just that the conversation went in really more interesting ways than I thought it was going to. But certainly have a lot of things I still want to get your feedback on next time. For folks that have really enjoyed this discussion and would like to follow you in your work, where should they go?
Send me an email at kevin@themacrotourist.com and I'll be happy to hook you guys up with some posts.
Okay. I'm going to go even further and say, go to themacrotourist.com and consider signing up and subscribing for the service.
You're very kind, Adam. Thank you.
Like I said, it's one of the most successful financial Substacks in the world. So people, if you really like this, obviously you get the best of Kevin through his Substack. I'm a subscriber, and by the way, I announced the launch on this channel last week of the new Macro Pass service, which I'm offering to my premium Substack subscribers, where every week you get a premium report from one of the experts that's on this channel. Kevin has very kindly agreed to be in that faculty. And so just as an FYI, Kevin, thank you for doing that.
My pleasure. It's a great honor to be included.
You're very kind. So anyways, macro pass subscribers, keep your eyes out at some point in the not too distant future. We're going to include one of Kevin's reports from the macro tourist. If you've enjoyed this conversation, would like Kevin to kindly come back on the program when it next fits in his schedule, please let him know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Kevin, I got one last question for you right
Sure.
before we get to it. Just a reminder for folks, for all things thoughtful money, to sign up for our free newsletter, to upgrade to the premium version of it and get the macro pass with all my notes and all the other benefits you get from being a premium subscriber. Or more importantly, you want to get some help in terms of considering how to put a lot of the insights that Kevin shared with us today into action in your own portfolio. Highly recommend, if you're going to do that, you do it under the guidance of a good financial advisor, good professional financial advisor. Most importantly, one that takes into account all the macro issues that we've talked about here with Kevin. But if you don't have a good one already, or you'd like a second opinion from one who does, you can schedule a free consultation with the financial advisors that Thoughtful Money endorses. These are the guys you see on the channel with me week after week. To do that, just go to thoughtfulmoney.com and click or fill out the short form there. All right, Kevin, last question for you here as we wrap up. You are a gentleman who has been a very successful investor. You clearly have a very sophisticated understanding of how the markets work. You've now gone independent. You're doing your own thing. I'm curious, in your journey, what's one of the biggest lessons that you've learned that you think would be valuable to share with listeners here? This can be something a big mentor told you. It could be a lesson that the School of Hard Knocks beat into you along the way. But yeah, do you have a formative insight to share?
Sure. I'm going to give you two, actually. One's kind of more of a life lesson and one's a market lesson. So we'll start with the life lesson. And this is probably geared towards the younger listeners. I wasn't patient enough. I was very there's a lot to be said for enthusiasm. There's a lot to be said for running out and grabbing hold of stuff, but there's also something to be said for just taking your time and expecting things to unfold in a way that might seem like they're going slow to you as a young person, but then in reality, that's just life. And for example, I worked at a bank, and when I was at the bank, I was very frustrated at a lot of the things that they wouldn't let me do, and they'd get mad at me, or it seemed like all they could do is tell me, you can't trade this, you can't trade that. And now as a 53-year-old, I'm sitting there going, God, they were really nice to let me trade all those crazy things in the first place. And I was and so with the benefit of being a little bit older, I realized that I wasn't probably patient enough, and I was expecting too much too fast in terms of how it evolved. Anyway, so for young people, I would say keep working hard, and also just realize that things are probably going to be a little slower than you expect from that way. So be patient. And then from a market point of view, this is something that's taken me a while to learn, and I've learned it by talking to some of the smartest, richest, most successful investors I know. One of the things that I've noticed about them is that they all use long-term options in a way that I never really appreciated before. As I mentioned earlier, I was a big seller of volatility, and I rarely owned volatility or owned options because it seemed to be that it was just a losing trade to me. And what I found when I started talking to these successful investors is a lot of times they would buy 1 year, 2 year options, and they would buy something that would give them the ability to not have to time it perfectly, meaning that the option was long enough that they didn't have to get it specifically like this month, this thing's going to go up, and yet gives them also leverage when it started going their way. So for example, like GDX, you were talking about the gold miners, they might go buy a 1 year or 2 year, 30 delta call. And that was something I just never appreciated before. And I never understood how, when you have that trade and you have the ability to not have to time it perfectly because the option's not decaying as fast, it then lets you ride the leverage when it does work for you.
All right. Wow. Thank you. I think those are two certainly very valuable insights. The second one, when a long-term successful investor, shares something like that, you better open up your ears and listen to it. To be more patient one, I totally agree. And I mean, I remember, when I was getting started, my first job was out working for an investment bank, and we were all, our first year, we were all just, totally affronted and stressed about, wanting to get more and more models to build. And,
Yeah.
they kept just saying, "Hey, slow your roll. You'll get there." And of course, to your point, once you get experience, you realize, oh yeah, there's a reason why they don't just give a fresh out of college recruit, the Excel model to build for the, $100 million deal that's getting done, right? And it makes you think. I talk a lot in this channel about learning and how to build mastery, and one of the more successful models is sort of the mentor apprentice model that existed in the past. And you see, especially in places like Japan, where the apprentice oftentimes like sweeps the floor for 2 years right before they actually let him do anything. And a big part of that, though, I think, is because of the value of observation. Right, we're there, we all want to do, right? And to your point, work hard, get the experience you can get, but don't underestimate the value of observing a master at their craft, and really letting that sink in and asking lots of questions and really just kind of being a sponge. It's one of the best ways to really go slow at first to go fast later on.
Right.
So highly agree with it. All right, Kevin. Well, look, this is as always just been a fantastic conversation. Thanks for sharing so much of your time and so much of your personal insights with us as well. Really look forward to having you back on. Of course, if anything happens that changes the way that you see the world, and you don't want to wait for another invitation from here, but you want to come on and say, "Hey, everybody, here's something big I've noticed." You've got an open invitation to come here anytime you like.
That's great. It's a real pleasure being here. And you know what? I saw you sum up my argument about the patients, and I think I should let you do it. I should go the other way. I should be interviewing you, Adam.
Anytime you like, brother. All right.
All
Well,
right.
Kevin, look, thanks so much, buddy. Everybody else, thanks so much for watching.
Thank you.